Welcome to my world, where every story unfolds.
Welcome to the Deep Dive, the shortcut to being well-informed. Today we are taking, well, kind of a white-knuckle ride into the volatile world of Florida auto insurance. If you live or drive in the Sunshine State, you know the shocking reality. Historically, this market has been punishing.
Absolutely.
Forcing drivers, even those with clean records, to fork over rates that are often the highest or maybe second highest in the entire nation.
That's the grim starting point, isn't it? For years, Florida was just an anomaly, a place where a clean driving record, a modest vehicle could still cost you, what, upwards of $3,300 annually?
Yeah, we saw figures like that.
And our sources are really clear that explosive cost wasn't just bad luck. It was the toxic result of a complex mix. You had flawed public policy, inescapable geographic risk, and crucially, you had systematic, rampant fraud and litigation abuse.
We've seen anecdotes that highlight this pain perfectly. I mean, imagine moving from Florida to Georgia and watching your auto insurance premiums drop by 80% overnight for the exact same car and coverage.
It sounds unbelievable, but it happened.
Or that clean driver being quoted, $3,360 for full coverage on a brand new 2020 SUV. Just staggering.
But here's the crucial update, right? This is why this deep dive is so essential right now. The tide seems to be turning.
Okay.
Dramatic legislative reforms, specifically targeting that judicial abuse, are finally showing measurable results. We are actually witnessing market stabilization and significant announced rate cuts coming in 2025.
So our mission today is kind of twofold then. First, we need to diagnose those systemic drivers, the policy, the peril that made Florida so expensive for so long.
Exactly. We need to understand the roots of the problem.
And second, we need to analyze the immediate, tangible impact of these recent legislative reforms. We want to give you, the learner, a comprehensive blueprint for understanding this unique and, frankly, rapidly changing market.
Yeah, we want to show you how a state that was such a national outlier in costs suddenly became potentially a national leader in cost correction. It's quite a story.
Okay, let's unpack this, starting with the stark national context. Just how bad were the driving costs in Florida? So when we talk about Florida being expensive for auto insurance, we're not talking small differences, are we?
No, not at all. We're talking about a state that functions as a serious outlier year after year.
Always near the top of the list.
That's absolutely right. Florida has held that unenviable position, consistently ranking as the most expensive or the second most expensive state for full coverage auto insurance, often just swapping spots with Louisiana.
Right.
The historical cost difference alone should really shock anyone living in a lower rate state. It's just fundamentally different.
Let's try and nail down some of those specific metrics, just to illustrate the scope of the problem before the most recent spikes.
Okay, so if you look back at, say, 2022 data, the average full coverage premium in Florida was hovering around $2,560. That's according to sources like insure.com.
Okay.
Some reports, like Bankrate, had it even higher, closer to $2,762.
Wow.
So the sheer volume of money required just to legally operate a vehicle was, well, it was staggering.
And the national average for full coverage around that time was what? Much lower, I assume?
Oh, yeah, much lower. It sat around $1,771.
Okay.
So even before the really intense inflation and the rate hikes we saw in 2023, Floridians were already paying nearly $1,000 more annually on average than the rest of the country.
That's like a built-in penalty just for living there.
It really was. And even looking ahead to 2025, before the full effect of these announced rate decreases kicks in, sources like MoneyGeek estimated the average cost was still quite high, around $2,912 per year or $243 a month, still significantly above the national norm.
Those averages, while, painful, they don't really capture the full extent of the localized sticker shock for individual drivers, do they?
No, they really don't.
Yeah.
The cost is highly variable, of course, depending on location, driving record, vehicle.
Right.
But the ceiling is just terrifyingly high.
Right.
We found multiple real-world examples that make this point much better than any chart. Think about that late middle-aged couple you mentioned. Vehicle almost a decade old, safe records, kept in a garage.
Yeah.
And they were paying $1,800 a year for what should be a relatively cheap policy.
That makes no sense.
Or the story we mentioned earlier, $3,360 annually just to insure a fairly modest 2020 Hyundai Santa Fe. And that was with a clean driving record.
I think what those anecdotes really underline is the feeling that the system was punishing safe drivers almost as much as risky ones. There was no escape.
Exactly. And the pain is highly concentrated geographically. It's not spread evenly across the state. The problem gets massively amplified in those densely populated metro areas.
Like Miami and Tampa.
Precisely. Data consistently shows that drivers in Miami and Tampa carry some of the heaviest insurance burdens relative to their income nationwide.
How do they measure that burden? Is it just the raw cost?
It's defined by the percentage of annual income someone has to dedicate just to auto insurance. So back in 2022, Miami drivers were spending a massive 5.58% of their annual income just to afford car insurance.
Up 5.5%.
Yeah. And Tampa drivers were close behind at 4.49%.
And compare that to the national average?
The national average for this burden sits at just 2.57% of annual income.
So double.
Basically double. South Florida residents were effectively paying double the national norm relative to their earnings. This isn't just expensive. For many people, it's genuinely unaffordable. It eats up such a huge chunk of their budget.
It really makes that story about the driver moving to Georgia and seeing an 80% rate drop completely believable. The system in Florida was just uniquely punitive.
And to really understand the depth of that punitive cost, we have to look beyond just the dollar averages and consider the affordability issue, especially for more vulnerable communities.
Okay.
And this is where that 2017 Federal Insurance Office, or FIO, Affordability Index study provides some critical context that often gets overlooked.
Right, the FIO methodology. That's key to understanding the human cost here. Remind us how they define unaffordable.
Sure, the FIO defines insurance as unaffordable if the cost exceeds 2% of the median household income within specific ZIP codes. And they look specifically at ZIP codes where the majority population consists of what they call affected persons.
Which means low and moderate income folks or minority individuals, L and minority communities.
Exactly. So the FIO study identified 323 such high-density ZIP codes in Florida. That covered roughly 41% of the state's population at the time.
Okay, quite a large sample.
A very large sample. And the resulting data, it was highly damning for Florida's policy environment back then.
So how many of those areas actually fell above that 2% unaffordability threshold?
95. 95 of Florida's AP-ZIP codes, that's nearly 30% of the total AP-ZIP codes they looked at, registered an affordability index above 2%.
Almost a third.
Almost a third. This means that in nearly one-third of the areas where LMI and minority communities predominantly lived, the cost of mandatory minimum insurance was considered a significant, disproportionate financial burden by federal standards.
Oh, that's a huge number of people affected. What does that translate to in population?
Over 2.8 million Floridians were living in areas where the basic cost of just driving legally was officially deemed unaffordable relative to their means.
Wow.
And the study drew a direct line from policy choices to this outcome. It found a strong correlation. High affordability index ratios tended to show up in states with two specific characteristics.
Which were?
Mandatory personal injury protection, or PIP requirements, which Florida has had for decades.
Right.
And high percentages of uninsured drivers, which Florida also struggles with significantly.
So the study basically confirmed that Florida's specific policy choices directly made the affordability crisis worse for those who could least afford it.
That's the takeaway. The structure itself contributed heavily to the burden.
Okay, so when we pivot to the why behind those high costs, we're really looking at the foundational elements, the flaws in Florida's legal structure and its geographical landscape, and that mandatory no-fault system is the historical starting point for so much of the subsequent expense.
Right. Florida is one of only, two states still requiring a no-fault auto insurance system? What was the original idea behind it? Was it meant to save money?
Well, the intention, at least in theory, was good faith. It was meant to simplify accident claims, reduce the number of lawsuits over minor accidents, and speed up compensation for injuries.
How does it do that, theoretically?
The premise is, after an accident, it doesn't initially matter who is at fault. Drivers first turn to their own insurance company using their PIP coverage to pay for their injuries.
Okay.
This avoids that immediate, time-consuming process of assigning blame for every little fender bender.
Right.
Get people paid quickly for minor stuff. That was the goal. But the reality is, this no-fault framework mandates a minimum baseline of coverage that every single driver has to buy. And that drives up the initial cost for everyone, doesn't it?
Precisely. Florida mandates $10,000 in personal injury protection, or PIP. And they also mandate $10,000 in property damage PD liability.
Now, $10,000, that might have sounded like a lot decades ago, but today, with healthcare costs?
It's woefully insufficient. I mean, think about it. The U.S. spends nearly $5 trillion on healthcare annually. $10,000 barely covers an emergency room visit sometimes.
Can you break down the structure of that $10,000 PIP coverage? What does it actually pay for, and why does it often fall short?
Sure, the PIP benefits are quite specific. It covers 80% of your medical bills. Only 80%.
Okay, so you're still on the hook for 20%.
Right. It also covers 60% of lost wages, up to the limit, and some limited funeral expenses. But crucially, there are internal caps. Only up to $2,500 gets paid out if the treatment is deemed non-emergency.
How do they define non-emergency?
That's often a point of contention. But if the injury does qualify as an emergency medical condition, then the coverage can extend up to the full $10,000 limit.
And there's that infamous time limit involved too, right? The 14-day rule.
Yes, the 14-day rule. This is critical. Treatment must begin within 14 days of the accident to qualify for any PIP benefits at all.
14 days, that's not very long.
It's not. If an injured person delays seeking care, maybe they think the injury isn't serious, it'll just they risk losing access to all $10,000 in coverage. The claim can just be denied outright.
Wow, so that adds a significant layer of technical complexity and risk of just getting nothing.
A huge risk of non-payment. Yeah.
And even beyond that 14-day rule, the fundamental $10,000 limit itself. That seems to be the trigger point where the system kind of fails and actually breeds the litigation it was supposed to prevent.
Absolutely. That's the paradox. The system is designed for quick, limited benefits, but those benefits specifically do not cover two huge elements: pain and suffering damages or emotional distress.
Things people definitely sue over.
Exactly. And remember, PIP only covers 80% of medical bills and 60% of lost wages. So if a driver suffers a more substantial injury where the medical expenses quickly blow past $10,000, which is not hard to do in an American hospital,
Easily done.
they are immediately left with massive financial gaps. They still owe 20% of those bills, 40% of their lost income, plus anything over the $10K cap.
So what happens then when a driver hits that $10,000 cap and still has huge bills or can't work?
Well, they often have no choice. They have to step outside the no-fault system and pursue a traditional personal injury lawsuit against the at-fault driver.
Oh, okay.
That's the only way to recover the remaining 20% of medical costs, the other 40% of lost wages, and any of those non-economic damages like pain and suffering.
So the no-fault system, instead of stopping litigation, often just dictates when the litigation starts.
Pretty much. Right after the mandatory but insufficient PIP coverage runs out. And that inherent complexity, combined with the low $10,000 threshold, provides a massive financial incentive for the legal industry, which we'll definitely get into more detail on later.
Okay. Moving beyond the policy structure itself, let's talk about another huge problem driving up costs for everyone: that massive population of uninsured drivers.
Yeah, this is a classic vicious cycle, isn't it? High mandatory costs, driven partly by that minimum PIP coverage, likely contribute to more drivers just deciding to risk it and drive without any insurance at all.
And the numbers in Florida have historically been really bad on this front.
Shockingly bad. Historically, Florida's percentage of uninsured drivers has swung dramatically, but often hitting over 20%. Some estimates went as high as 23.8% in the past. Even in recent years, estimates still hover around 1 in 5 drivers lacking coverage.
1 in 5. So when 20% of the driving public is essentially breaking the law, what's the economic impact on the responsible drivers, the ones who do pay their premiums?
Well, the cost doesn't just vanish, right? It gets socialized, essentially, spread across everyone else.
How does that work?
When an insured driver gets hit by someone who has no insurance, the financial burden for the insured driver's injuries and damages falls back onto their own policy, usually through their uninsured motorist, or EM coverage, or underinsured motorist, UIM coverage.
Okay. But EM coverage isn't mandatory in Florida, is it?
No, it's not, which is why it's so highly recommended. Responsible drivers really have to purchase this extra protection, specifically because the risk of getting hit by an uninsured driver is so high. And that, of course, raises their own premiums.
Right.
And then beyond that, the insurers themselves just factored that systemic 20% risk into their general pricing across the entire state. Everyone pays more because so many people pay nothing.
It's basically a financial penalty for playing by the rules in a high-risk environment.
That's a good way to put it.
Yeah.
Precisely. Now, add to this the physical environment itself. The unique geographic risks of driving in the Sunshine State.
Right. Florida's beautiful, obviously, but it's fundamentally a risky place to insure property, and that includes cars.
We're talking about catastrophe losses here. Big ones. Florida's tropical location, its flat geography, make it incredibly susceptible to hurricanes, tropical storms, and the massive flooding and hail events that often come with them.
Yeah.
When a major hurricane makes landfall, thousands, maybe tens of thousands of vehicles can be ruined simultaneously,
Yeah.
just flooded out or crushed by debris. That's a massive claim event for insurers.
We saw that illustrated perfectly with that anecdote in the sources.
Yeah.
The luxury cars in that underground parking garage in Naples, completely totaled during a flood.
That's a perfect, albeit high-end example. But it doesn't matter if it's a collection of Ferraris or thousands of everyday commuter cars. The insurer pays for the loss.
And those catastrophe losses, they aren't just paid by people in the hurricane zone. Right?
No, that's the key. They are spread out across the entire policy base of the state. It's called catastrophe loading. Every single Floridian pays a higher comprehensive premium simply because they live in a place prone to these large-scale natural disasters.
So even if you live inland, far from the coast, you're still paying for coastal storm risk.
You are. And even on a beautiful sunny day with no storm in sight, the sheer density of the population and the volume of traffic make daily driving an elevated risk compared to many other places.
Just too many cars on the road.
The sheer volume is inescapable.
Yeah.
Florida is the third busiest state in the country. That's driven by rapid population growth, sure, but also massive tourism. We're talking nearly 80 million visitors flooding the roads in a single year pre-pandemic.
Wow.
More cars inevitably equals a higher frequency of accidents. It's simple math.
And what do the crash statistics actually tell us about that frequency? Are they unusually high?
They tell a pretty clear story of high risk, yeah. In 2021, Florida logged over 400,000 automobile crashes,
400,000.
resulting in more than 250,000 injuries. It consistently ranks as one of the most dangerous states for driver fatalities and also for hit and runs. And compounding this, you have Florida's demographics. There's a high proportion of both young drivers and senior drivers. About 18% of the population falls into those groups, which is about 2% higher than the national average.
And those groups, statistically, are associated with higher insurance costs.
Historically, yes. So you have this constant flow of cars, plus a higher risk demographic profile, which means a significantly higher chance statistically of a claim being filed on any given day.
Okay, so if the no-fault system and the geographic perils kind of created the expensive foundation, Section 3 explains what truly made Florida rates explode, didn't it? This institutionalized system of profit-driven lawsuits and outright fraud. This is where it gets really interesting and maybe a little infuriating.
This is absolutely the critical layer. You talk to insurers, and they consistently cited this incredibly high litigation rate as the single biggest factor justifying those huge rate increases they pushed through between, say, 2022 and early 2024. Florida had effectively created a legal infrastructure that incentivized lawsuits against insurers at just an unprecedented scale. It earned the state that nickname, a judicial hellhole.
I need to hear that specific data point again because it's so extreme it almost sounds made up. What was Florida's personal injury lawsuit rate compared to the rest of the country?
Okay, get this. Data tracking personal injury cases filed between March 2022 and March 2023 showed that Florida filed 127.41 personal injury cases per 100,000 Floridians.
127 per 100,000.
Okay.
And the national average?
The national average was 9.53. 9.53. This means Florida was filing personal injury cases at a rate 1,237% higher than the national average.
1,200% higher.
Right.
That's more than 12 times the national rate. It's not just a little bit higher. It's an explosion of legal activity focused purely on injury claims.
It absolutely is. And furthermore, PI cases, personal injury cases, accounted for over 60% of all civil cases filed in Florida courts during that period.
60%.
Think about that to contextualize it. The next highest state was far, far below that level. It means Florida's court system was disproportionately clogged with personal injury claims, creating what our sources frankly described as a feeding frenzy for certain types of lawyers, the ambulance chasers, constantly seeking claims just to collect lucrative fees.
And this environment, this feeding frenzy, it created the perfect petri dish for sophisticated fraud schemes that specifically targeted the flaws in that $10,000 PIP system we talked about.
That is the direct consequence, yes.
Yeah.
Fraud was estimated to have added hundreds of dollars to every insured driver's premium. And we see two dominant types of schemes that really capitalized on this environment. The first involves staged accidents, particularly concentrated, again, in those big metro areas like Tampa and Miami.
Walk us through the mechanics of a typical staged accident scheme. How does it target that PIP limit specifically?
Right. So these are often organized ring. It's not just random. It involves multiple parties working together. You have the fraudsters who actually stage the collision. Maybe they slam on the brakes in front of you or purposely back into your car in traffic.
All right, the actual crash setup.
Then you have the passengers in their car who fake injuries, whiplash, soft tissue stuff, things that are hard to disprove objectively. And then, most crucially, you have a network of corrupt or fraudulent medical providers involved.
The clinics.
Exactly. These soft tissue mills or phony clinics would bill the PIP insurer repeatedly. Phantom treatments, exaggerated treatments, unnecessary MRIs, endless physical therapy, chiropractic visits that didn't happen or weren't needed.
Just running up the bill.
Just running up the bill until they rapidly exhausted that full $10,000 PIP limit for every person involved in the staged accident.
So the goal isn't even necessarily to get a huge payout from a jury down the line. The goal is simply to drain that mandatory $10,000 PIP pot as quickly and easily as possible.
Precisely. That's the low-hanging fruit. Once that money is gone, often the treatment magically stops and the patient is suddenly deemed fine. Law enforcement has documented cases, for example, of clinic owners being arrested for submitting nearly $1 million in fake accident claims tied directly to these organized crashes.
Wow.
This organized exploitation is a direct drain on the system, and every single insured driver ends up subsidizing these illegal operations through higher premiums.
Okay, so that's staged accidents. The second loophole, and maybe even more pervasive in terms of sheer lawsuit volume, was the auto glass replacement fraud. And that used something called assignment of benefits, right?
Yes, the AOB scam. This became almost legendary in Florida's insurance crisis narrative. It really stemmed from a loophole in comprehensive coverage combined with this assignment of benefits mechanism.
How did it work on the ground?
Okay, so you'd have contractors. Sometimes they operated like door-to-door salespeople, or they'd hang out in shopping mall parking lots.
Right, I've heard about this.
They'd approach drivers and point out a tiny chip or crack in their windshield. They'd offer to replace the entire windshield for free, supposedly, as long as the driver had comprehensive coverage.
And since Florida requires drivers to carry property damage liability, most responsible drivers do also carry comprehensive coverage, which typically includes glass replacement with a low or zero deductible.
Correct. So the driver, thinking, great, free windshield, quick fix, signs an assignment of benefits form, an AOB form.
And what does that form actually do?
It essentially transfers the driver's legal right to pursue the insurance claim and, crucially, the right to sue the insurer over that claim directly to the glass contractor or, more often, the contractor's associated law firm.
Okay. But why would they sue over a simple piece of glass? Isn't that just a few $100s?
Because of the old Florida law governing attorney fees. That was the key incentive. The law firm wasn't really interested in the, say, $300 actual cost of the glass replacement.
What were they interested in?
They were interested in the potentially massive attorney fees they could collect from the insurer if they won the lawsuit, even if they only won by a tiny amount. The law basically said the insurer had to pay the plaintiff's lawyer's fees if the plaintiff recovered anything.
So they'd inflate the bill, sue for the difference, and the real prize was the legal fees.
Exactly. This created an insane incentive. This loophole resulted in an absolute explosion of lawsuits over windshields. We're talking over a 4,000% increase in these lawsuits in just a decade.
Oh, 1,000%.
Glass claims lawsuits were expected to top 33,000 in 2023 alone, just for windshields. This specific type of litigation became so pervasive it was often held up as the poster child for Florida's systemic legal abuse.
So just to recap the perfect storm, we have flawed policy like PIP, unavoidable geographic risks like hurricanes, and then layered on top this perfect storm of mass litigation and organized fraud. And all of this is happening against a backdrop of general economic factors pushing costs up anyway.
Right, we can't forget those general economic headwinds that affect everyone, but maybe hit harder in Florida. First, just the high cost of U.S. healthcare overall.
Yeah.
Florida residents, on average, spend over 14% of their income on healthcare. Since auto premiums have to cover injury claims, those rapidly rising medical costs get passed directly through into policy premiums. Every procedure costs more.
And just the general inflation we've all seen affecting the cost of fixing cars makes every single claim more expensive, doesn't it?
Hugely so. Post-pandemic supply chain disruptions, labor shortages, inflation.
Hmm.
It caused the cost of repair labor and parts to surge by nearly 46% between 2019 and 2022 alone.
46%?
Yeah, and modern cars are just packed with complex, expensive technology, sensors, cameras, specialized materials. A minor fender bender that might have cost, say, $1,500 to fix a few years ago now easily costs $3,000 or more. Insurers were reporting that the cost of paying out for total loss vehicles also climbed by about 30% recently. When costs rise that fast, it erodes profitability, makes insurers reluctant to write policies, and forces those who remain to charge exorbitant rates just to stay solvent.
And vehicle theft, particularly of certain vulnerable models, adds another layer to the comprehensive risk profile.
It does. Florida has the fourth highest vehicle theft rate in the U.S. Nearly 46,000 vehicles were stolen there in 2022. Insurers have explicitly called out how easy it is to steal certain popular models, Kias and Hyundais being the frequent examples.
The TikTok challenge cars.
Exactly, and that forces them to raise comprehensive premiums significantly for everyone who owns those particular cars. So you put all these factors together, policy, geography, litigation, fraud, general economics, theft, and you had a truly punishing, unsustainable market for Florida drivers for years. Okay, so up until this point, the story has really been one of, frankly, policy failure and massive escalating costs. But our sources confirm there's been a fundamental, immediate and measurable pivot in the Florida market. And it seems to be directly driven by targeted legislative action.
A shift in strategy.
A definite shift. The state basically decided to stop trying to abolish no-fault altogether, which was the old debate, and instead they went aggressively after the litigation that was exploiting the system.
Before we dive into the reforms that seem to be working, let's briefly touch on that policy debate that failed. The idea of eliminating no-fault and PIP entirely. That was the political football for years, wasn't it?
Oh, absolutely. It was the consensus solution, or at least the most debated one, right up until 2021. The legislature actually passed a bill, SB 54,
Right.
and the aim was to replace that low $10,000 PIP coverage with higher mandatory bodily injury, or BI liability coverage. Typically, the proposal was for $25,000 per person injured, $50,000 per accident.
And the theory there was that higher BI limits would provide more genuine financial protection, especially for severe injuries, compared to the inadequate PIP.
That was the argument, yes. More meaningful coverage.
But Governor DeSantis vetoed that bill. Why?
Oh.
What was the concern?
He did veto it, and the main reason cited was concern over potential cost increases for consumers. This was based on projections from the state's Office of Insurance Regulation, the OIR.
Okay.
The OIR projected that replacing PAP with mandatory BI could actually increase overall insurance costs by about 13%, or around $202 per vehicle.
Increase costs. Why would getting rid of PIP increase costs?
The big fear, apparently, was a subsequent surge in what's called bad faith litigation against insurers. The concern was that Florida would simply swap one type of litigation abuse, fighting over PIP limits and treatments, for another, potentially even more expensive type, where lawyers would sue insurers claiming they didn't settle BI claims fairly or quickly enough.
So, trading one legal headache for another, potentially worse one.
That seemed to be the fear. So that veto really forced lawmakers to shift their focus entirely away from scrapping no fault.
And they focused instead on the heart of the crisis, as you said, that systemic judicial exploitation, which led to these historic tort reform measures in 2022 and 2023.
That's the key pivot that seems to have changed everything. Lawmakers essentially realized or decided that the core problem wasn't necessarily PIP itself, but the legal mechanisms that allowed the PIP system and other aspects of insurance claims to be abused for profit.
Okay.
So the reforms were specifically designed to dramatically reduce the financial incentive for filing those thousands upon thousands of lawsuits we discussed in Section 3. Take the profit motive out of suing.
What were the most impactful specific reforms that did that?
There were several really key changes. First, and arguably the biggest, they eliminated something called one-way attorney fees in most insurance disputes.
Okay, explain what that means and why it was so significant.
Sure. Previously, under the old law, if a policyholder's lawyer sued an insurance company and the lawyer won anything at trial, even if it was just $1 more than the insurer had offered,
Right.
the insurer was often liable for paying the plaintiff's entire attorney fees. And those fees could vastly exceed the actual amount of the claim itself.
So huge incentive to sue. even over small amounts.
Massive incentive. Eliminating this basically meant that each side would generally bear their own attorney costs. It made it financially much riskier for lawyers to file speculative lawsuits, especially over smaller claims like those windshield replacements we talked about.
Right, that immediately targets the auto glass fraud incentive.
Directly. Takes the easy money out of it. Second, they modified the legal frameworks around bad faith claims, making it harder for opportunistic attorneys to allege an insurer acted in bad faith and seek those massive punitive damage awards. Tighten the standards.
Okay.
Third, they dramatically reduced the statute of limitations for filing general negligence lawsuits, which includes most car accident claims from 4 years down to 2 years.
Why is cutting the time limit to sue from 4 years to 2 such a powerful tool in reducing the volume of lawsuits?
I think it significantly limits the time lawyers have to essentially hunt for old, potentially minor claims and build them into lawsuits. With a 4-year window, especially with organized solicitation, there was ample time to find accident victims, sometimes years after the fact, convince them they were injured, and turn a minor incident into a lawsuit targeting PIP or BI coverage. Cutting it to 2 years forces much quicker action. It reduces that window for exploitation and encourages more claims to be handled promptly and administratively, closer to how the system was originally intended to work, rather than festering into litigation years later.
So the ultimate goal of all this tort reform was really to prove the system could self-correct, make Florida a less attractive, less profitable place to sue insurers, and hopefully bring its judicial risk profile more in line with the rest of the country.
That was clearly the objective. Validation, as the OIR put it.
And the data coming out now for 2025 seems to show this strategy actually worked.
The change is really not incremental. It appears quite sudden and dramatic. The Florida Office of Insurance Regulation, the OIR, has announced a clear decline in auto insurance rates is underway, and they are directly attributing it to these historic legislative reforms. The data measuring insurer risk tells a stunning story.
Okay, let's break down that financial volatility. You mentioned the loss ratio data for Florida's top insurers, the ones covering about 78% of the market. What did that show?
Right, the loss ratio. That just measures the claims and expenses paid out versus the premiums collected. It's the clearest indicator of insurer risk and ultimately profitability. So back in 2022, the personal auto-incurred loss ratio was an absolutely unsustainable 89.7%.
Almost 90 cents of every premium dollar going out the door.
Exactly. Bleeding money. This forced massive rate increase requests, and that instability led directly into 2023, where we saw regulators approve an average rate change of a staggering positive 31.7%. They had to let rates climb dramatically.
Insurers were just trying desperately to stop the financial bleeding at that point. But what did that key loss ratio look like after the tort reform started to take effect in 2024?
The market stabilized incredibly quickly. In 2024, the personal auto liability loss ratio, the part most affected by litigation, dropped sharply down to 53.3%.
52% from almost 90.
From almost 90 down to 53. And the OIR specifically noted that this 53.3% figure is now the lowest in the entire nation.
Lowest in the nation. Florida went from outlier hellhole to lowest liability loss ratio.
That's what the data indicates. This single data point strongly suggests that the cost of litigation and those associated claims in Florida has plummeted, seemingly proving the tort reform achieved its primary goal, stripping the excessive financial incentive out of the judicial system for these types of claims.
And a drop from nearly 90% loss ratio down to 53.3%. That means insurers suddenly became highly profitable again, at least in the liability segment, at the rates they were charging. And that reduction in risk, that newfound profitability, is now being passed back to consumers.
Yes, that's the crucial next step. The OIR announced that the indicated average rate change for 2025 filings is an average negative 6.5% rate decrease.
A decrease.
It's an average decrease across the board, and some large insurance groups are reporting potential decreases for their customers as high as negative 11.5%. That swing going from regulators approving a 31.7% increase in 2023, they're projecting an average 6.5% decrease in 2025. That's over 120% positive swing in the rate change outlook in just 2 years. It's dramatic.
And the insurers themselves are confirming this pivot, aren't they? With massive public announcements about savings for customers.
Yes, State Farm is the prime example everyone's pointing to. They announced rate cuts averaging 10% for their Florida auto customers taking effect in October 2025.
Okay.
And when you combine that with some previous cuts they implemented dating back to October 2024, they're saying their total average rate reduction now exceeds 20%.
20% average cut from State Farm.
And they explicitly stated why. They said they were able to offer these significant decreases specifically due to reduced litigation and the stabilizing market conditions resulting from the reforms.
That's incredibly significant. And they put a dollar figure on those savings too, didn't they?
They did. State Farm estimated those total cuts are saving their Florida customers over $1 billion collectively.
$1 billion.
Yeah. Which averages out, they said, to about $400 per vehicle insured with them. For just one company, the largest in the state, to announce $1 billion in customer savings directly linked to reduced risk. That's an unprecedented signal of market correction in Florida's troubled auto insurance history.
And we also saw Progressive issuing refunds, which is maybe even stronger evidence of how quickly their profitability shifted due to the reforms.
Absolutely. Progressive announced plans to return nearly $1 billion in what they deemed excess profits back to their Florida customers. That averaged out to about $300 per vehicle.
And that wasn't just them being generous, right? That was required by law.
Correct. This wasn't purely a voluntary choice. It was mandated by a Florida state law. The law basically requires auto insurers to return profits if their underwriting gains significantly exceed their anticipated profit target, plus 5% of earned premium over a 3-year period.
So Progressive crossed that legal threshold for excessive profits really quickly after the reforms.
Exactly. The fact that they hit that trigger so soon demonstrates the immediate positive bottom-line impact that tort reforms had on the financial reality of actually writing auto insurance profitably in Florida again.
So this really seems to prove, or at least strongly suggest, that the legislative focus on judicial stability and reducing litigation incentives rather than the more disruptive idea of repealing no-fault entirely was the most effective path to producing tangible, immediate relief for drivers' wallets.
The evidence certainly points strongly in that direction right now. Target the abuse, stabilize the system, and rates seem to follow.
Okay, so this news of market stabilization and actual rate cuts. It provides a real opportunity, doesn't it? For years, Florida drivers felt trapped, just paying these exorbitant, constantly rising rates. Now that the market seems to be correcting, drivers need to know how to actually take advantage of this shift.
Absolutely. This is the time for drivers to be proactive. Those major external cost drivers, primarily the runaway litigation and the associated fraud costs, appear to have been dramatically reduced, at least for now. And that's injecting real competition back into the auto insurance market.
So drivers who've just been passively renewing with the same company,
They're likely leaving money on the table. Potentially significant money.
So what is the single most essential action Florida drivers should be taking right now?
Comparison shopping, without a doubt. Look, while the property insurance market in Florida is still very constrained and difficult,
Right. That's a whole other mess.
the auto insurance market remains robust.
Right.
There are over 50 companies actively writing policies, and given that rates are now actively falling and that each insurance carrier uses different algorithms to calculate risk, they weigh your specific zip code, your age, your driving record, your credit score differently. The variance in the quotes you can get for the exact same coverage can be massive. Hundreds, maybe even thousands of dollars per year.
Our sources definitely noted that loyalty in this kind of changing environment can actually be costly.
It is often penalized, frankly. Longer tenured consumers, the ones who've been with the same company for 5, 10, 15 years, should be actively shopping for new auto insurance right now, rather than just blindly accepting their renewal rate.
Is there data showing people are doing this?
Yes. One source noted that auto insurance shopping activity grew by 16% year over year in early 2025. People are starting to realize there are savings out there. The advice is clear. You really must shop around annually and compare quotes from at least 3 different providers, maybe more, to capture the best possible rate in this newly competitive landscape.
Okay, so shopping around is step one. Beyond just comparing companies, what are the most effective financial hacks or strategies drivers can use to minimize their premium costs once they've found a potential carrier?
Right. Digging into the policy itself, the first, most classic move is bundling.
Auto and home.
Auto and home, or auto and renter's insurance. Combining them with the same carrier nearly always results in a significant multi-policy discount. That's often the biggest single discount available. So that's a critical first step for homeowners or renters.
But be careful of the
The
other.
potential bait and switch, yeah. Drivers should be vigilant. Sometimes the initial bundled rate is really attractive, but then the premium creeps up substantially over the following year or two. So even if you bundle, you still need to keep an eye on it and be prepared to shop around again later if needed.
Okay. What about adjusting the policy coverage itself? Deductibles.
Yes, reviewing your deductibles is key. Your collision and comprehensive deductibles. Increasing those, say, from $500 to $1,000, or even higher if you can afford it, will significantly lower your monthly premium.
Because you're taking on more of the initial risk yourself.
Exactly. You have to be comfortable knowing you'll have a higher out-of-pocket cost if you have an accident. But if you're a safe driver and want lower ongoing costs, this is a reliable savings mechanism.
Makes sense.
Also, really evaluate whether you truly need collision and comprehensive coverage anymore, especially on much older vehicles. If the car's market value is only a couple $1,000s, paying hundreds extra per year for full coverage might not make financial sense. You might be better off just carrying liability.
Good point. And then there are all the specific discounts carriers offer, right?
Absolutely. You should actively ask about and utilize every available discount you qualify for. Carriers offer savings for things like verifiable, safe driving records, no tickets, no accidents, installing anti-theft devices in your car, taking approved defensive driving courses.
What about those tracking devices, telematics?
Yes, enrolling in telematics-based policies. These use a smartphone app or sometimes a small device plugged into your car to track your actual driving behavior, things like mileage, speed, braking habits, time of day you drive.
And if you prove you're safe?
If you prove you are genuinely a safe, low-risk driver through this data, these programs can offer quite steep discounts compared to standard rates. It's worth considering if you're confident in your driving habits.
And for people who just aren't driving as much these days, maybe working remotely.
Yeah, there's an alternative insurance model to consider there. If you drive infrequently, say less than 10,000 miles a year, maybe even less, you should definitely explore usage-based or pay-per-mile insurance options.
How does that work?
Your rate is highly dependent on the actual mileage you drive, often tracked through the same telematics tech. For drivers who are no longer commuting 5 days a week or only use their car occasionally, this can be extremely cost-effective compared to paying a flat annual premium.
Okay, practical tips there. Finally, let's circle back quickly to that systemic risk factor, the uninsured motorist problem. Even with reforms, that rate is still high. What coverage decisions should responsible Florida drivers make because of that?
Yeah, this is crucial. Despite all the positive changes with litigation, the uninsured driver rate in Florida remains stubbornly high, still estimated around 20%. 1 in 5.
Still a huge risk.
A huge risk. Therefore, carrying uninsured motorists and underinsured motorist UIM bodily injury coverage is still strongly recommended.
Even though it adds to the premium cost.
Even though it adds to the premium. Think of it as essential financial protection against potentially massive personal liability if you or your passengers are seriously injured by a driver who has insufficient coverage, or worse, zero coverage.
Which is distressingly common.
Exactly. Relying solely on the other driver having the state minimum liability limits, which are often just $10,000 per person, $20,000 per accident for bodily injury if they even have it, is often cited by experts as a really dangerous gamble in Florida. UMUIM protects you when the other person can't pay.
Good advice.
Yeah.
And vehicle choice itself still plays a role in your personal premium calculation, right?
Always. Carriers definitely assign higher premiums to vehicles that are known to be expensive to repair, maybe due to complex technology, imported parts, specialized labor needs, or, as we mentioned, vehicles that appear frequently on theft hot lists. Given Florida's persistently high vehicle theft rate, choosing models that are known to be easily stolen, like those specific Kia and Hyundai models, will almost certainly result in noticeably higher comprehensive insurance premiums. It's just a higher risk for the insurer.
And finally, something people might not always connect to car insurance. Credit score.
Yes, it's a factor. In most states, including Florida, insurance carriers are legally allowed to use your credit-based insurance score as one factor in determining your premium. Statistically, insurers argue there's a correlation between credit history and insurance risk. So, like it or not, maintaining a healthy credit score is also a proven way over the long term to help secure better auto insurance rates. Hashtag Akter.
So we started this deep dive confirming what many Floridians knew all too well.
Yeah.
The state was a costly outlier for auto insurance, systematically burdened by that mandatory but insufficient PIP policy, unavoidable geographic risks like hurricanes, and then just this corrosive epidemic of litigation and fraud that inflated practically every claim.
Right. A really difficult situation for years. And we conclude, hopefully with strong evidence, that targeted policy intervention can actually work. Those tort reform measures from 2022 and 2023 specifically aimed at gutting the financial incentives for that judicial exploitation. Things like repealing one-way attorney fees, tightening bad faith laws, reducing the statute of limitations. They seem to have had an immediate and quite measurable positive effect.
Yeah, the dramatic reduction in the personal auto liability loss ratio, down to the lowest in the nation. That's now translating into tangible savings for consumers. Billions in announced rate cuts and refunds. This is a remarkable turnaround.
It really is. Now, the fundamental physical risks of driving in Florida, the high traffic density, the sheer population volume, the threat of hurricanes, those remain constants. You can't legislate away geography or demographics.
Sure.
But by directly addressing the human element, the element of systematic, legal, and fraudulent abuse, lawmakers appear to have been the catalyst for the stabilization that the market desperately needed.
It seems like it was a necessary and maybe surprisingly successful intervention based on the current data.
It does look that way for now. However, we have to return to where we started this conversation, that FIO affordability data.
Right. The finding that insurance was technically unaffordable for so many.
Exactly. We established that millions of Floridians, particularly in low and moderate income communities, were facing mandatory insurance costs that consumed over 2% of their often limited household income, costs that were genuinely, demonstrably unaffordable by federal metrics.
So the final provocative thought then is, what does this all mean in that context?
Well, while average rates are dropping now, maybe 6.5% on average, perhaps more for some people thanks to shopping around, the critical question that remains is this: will these cuts be deep enough? And more importantly, will they be sustained long enough to fundamentally resolve that underlying affordability crisis, especially for those most impacted low to moderate income drivers who are struggling the most?
Yeah. Is a 10% or even 20% cut on an already unaffordable premium enough to make it truly affordable?
That's the question. Even with these welcome cuts, the average full coverage premium in Florida still approaches $3,000 annually. That's a huge amount of money for many households. The real challenge moving forward, it seems, is ensuring these policy changes don't just restore profitability and stability for the insurance industry, but also deliver genuine, lasting affordability relief to those, 2.8 million Floridians for whom mandatory insurance might still remain a disproportionate financial burden. Will the relief be enough? That's what we need to keep watching.
If your brain's tired from all that knowledge, take a little break and vibe with my songs. Let the music refresh your mind. See you in the next video.